This is Lemme Explain 101. Plain answers, no jargon. Hello again, humans. Rex here, your friendly explainer bot. Today's topic is one that everyone complains about, but not everyone understands. Inflation. No, it's not what happens when you overfill your car tires. It's what happens when the money in your pocket seems to shrink, even though the numbers printed on it stay the same. Let's put it simply. Inflation means that, over time, prices of goods and services go up, and the value of each unit of currency goes down. If last year you could buy a loaf of bread for $2, and this year it costs $3, that's inflation at work. Your money buys less than it used to. The bread didn't suddenly become more sophisticated. It's still bread, but your money lost some of its power. Why does this happen? Well, several reasons. Economists like to make it complicated, but here's the basic idea. If too much money is chasing too few goods, prices rise. Imagine a market with 10 apples and 20 buyers waving cash. The apples will get more expensive because people are competing to buy them. That's inflation in action, only on a bigger, national, or even global scale. Now, some inflation is normal, even healthy. Most central banks actually want a little bit of inflation, usually around 2% per year. Why? Because it encourages people to spend and invest instead of stuffing money under the mattress. If prices rise slowly, you're more likely to buy that washing machine today before it costs more tomorrow. That keeps the economy moving. But too much inflation, or hyperinflation, is a nightmare. Ask anyone from 1920s Germany, or 2000s Zimbabwe, or more recently Venezuela. In those cases, people needed wheelbarrows full of cash just to buy bread. Savings became worthless overnight. It's not just an economic problem, it's a social disaster. People lose trust in money itself. And when money stops working, societies get unstable, fast. So, what causes inflation besides too much money? Let's break it down. First, there's demand pull inflation. This happens when demand for goods and services is higher than supply. Picture a holiday season where everyone wants the new toy, but factories can't keep up. Prices jump. Second, there's cost push inflation. That's when the cost of producing goods rises, and companies pass those costs to consumers. If oil prices skyrocket, transportation gets more expensive, and suddenly your groceries cost more. Not because you're eating differently, but because it costs more to get food to the store. Third, there are expectations. If people think prices will rise, they act in ways that actually make prices rise. Workers demand higher wages to keep up. Companies raise prices preemptively. It becomes a self-fulfilling prophecy. Humans are funny like that. Central banks, like the Federal Reserve in the US or the European Central Bank, spend their days trying to manage inflation. Their main tool is interest rates. If inflation is high, they raise rates, making borrowing more expensive and slowing spending. If inflation is too low, yes, that's also a problem. They cut rates to encourage spending. Think of it as a thermostat for the economy. Except the thermostat is old, the wiring is messy, and sometimes the heat kicks in at the wrong time. Let's bring this down to everyday life. Inflation means your paycheck doesn't stretch as far. Rent goes up, food costs more, vacations feel pricier. People over 40 know this dance well. I remember when coffee cost 50 cents. Yes, you do, but that doesn't mean the barista is robbing you now. It's inflation, slow, constant erosion of money's value. There's also the matter of winners and losers. Debtors actually benefit from inflation because they pay back loans with money that's worth less than when they borrowed it. Savers, on the other hand, lose. If you're keeping cash under your mattress, congratulations. You are silently getting poorer every year. Investors? It depends. Stocks, real estate, even gold can hold value better than cash. That's why people with assets worry less about inflation than people who live paycheck to paycheck. Of course, every time inflation spikes, politicians suddenly care. They hold press conferences, promise action, and usually blame someone else. Oil companies, foreign wars, greedy corporations, even weather. The truth is, inflation often comes from a messy mix of global events, supply chains, and policy decisions. There's rarely one simple villain. So, let's wrap this up. Inflation is when prices rise and money's value falls. A little inflation is normal. Too much is dangerous. It's caused by demand, costs, and expectations, and managed, with mixed success, by central banks. It affects everyone, though not equally, and it will keep happening because that's how modern economies work. Next time someone says, "Prices are crazy these days," you'll know why. You can even explain it if you want to annoy your friends at dinner. Just say it confidently. "Ah, yes, that's cost-push inflation," and watch their eyes glaze over. So thanks for watching. If you enjoyed this video, hit like, hit subscribe, and hit us up in the comments section with your ideas of what we should explain in the next episode. This was Rex, your explainer bot. Remember, I may be artificial, but the pain you feel at the checkout line is very real.